Certainly. Here is an engaging text about basic concepts and definitions for entering capital markets. Capital markets are markets where financial instruments are bought and sold, and prices are determined by supply and demand. These markets are essential financial tools for both investors and companies, contributing to the healthy functioning of economies worldwide. The primary instruments in capital markets are stocks, bonds, notes, and investment funds. These instruments provide various investment options for investors to choose from based on their investment objectives. Stocks represent ownership in companies. Companies go public by offering stocks, allowing investors to become shareholders and participate in the company's growth. Stock prices fluctuate depending on the company's performance, profitability, and future growth potential. Bonds, on the other hand, are debt instruments issued by companies. Companies issue bonds to investors and agree to repay them with a specified interest rate. Bonds are considered less risky investment options compared to stocks. Additionally, bonds and notes are among the debt instruments of companies. Governments can also issue bonds. Bonds are short or medium-term debt instruments that commit to repay with a specified interest rate. Lastly, investment funds are investment vehicles that allow investors to diversify their portfolios and reduce risks by investing small amounts of money. These funds are managed by professional portfolio managers and typically include stocks, bonds, and other financial instruments. An important component of capital markets is stock exchanges. Stock exchanges are markets where stocks, bonds, and other financial instruments are bought and sold. Transactions take place between buyers and sellers, and prices are determined by supply and demand. Capital markets make significant contributions to a country's economy and financial system. Investors can convert their savings into investments through capital markets, and companies can obtain financing through them. This financing enhances companies' growth potential and positively contributes to the national economy. How can investors cope with risks such as manipulation and fraud in capital markets? How does information asymmetry in capital markets affect investors, and how can investors overcome it? How can investors analyze price movements in investment instruments and make informed investment decisions? For all this and more, before starting the video, if you're interested in universal economic history, you can subscribe to my channel and turn on notifications to be informed about new videos I upload every day. Enjoy the watch.
Universal economic history.
After entering capital markets, investors can choose from a variety of investment instruments. These investment instruments include stocks, bonds, funds, and many other options. Stocks represent units that signify ownership in a company, with each share corresponding to a stake. Investors can invest in companies through stocks and earn returns based on the company's growth potential. In addition to investments, stocks allow investors to participate in the management of companies. Bonds are debt instruments issued by companies or governments. Bonds are issued with a specified interest rate and have a specific maturity period. Investors can make low-risk investments through bonds and earn a predetermined return. When investing, it is important for investors to establish suitable investment strategies. Investment strategies are determined based on investors' investment objectives, risk tolerance, and time frame. This article provides information about fundamental investment strategies such as long-term, short-term, and dollar-cost averaging strategies. Long-term investment strategy. The long-term investment strategy aims for investors to hold assets for an extended period. This strategy is typically applied to investment instruments with long-term growth potential, such as stocks and real estate. Investors in long-term investments often exhibit patience in the face of sudden price fluctuations, aiming to benefit from the returns of their investments over the long run. Short-term investment strategy. The short-term investment strategy aims for investors to hold assets for a short period. This strategy is commonly applied to investment instruments with price fluctuations within a short time frame, such as stocks and commodities. The short-term investment strategy aims to take advantage of sudden price fluctuations and aims for high returns within a short duration. Capital management encompasses strategies used to minimize risks and effectively manage assets when making investments. This article provides information on the fundamental elements of capital management, including risk management, portfolio management, and asset management. Risk management. Risk management is a strategy employed by investors to identify and minimize risks. This strategy helps investors identify potential risks and determine how to mitigate them. Risk management aims to reduce the risks investors face when making investments, maximizing investment returns. Portfolio management. Portfolio management is a strategy that helps investors diversify their assets to minimize risks. This strategy allows investors to diversify their portfolios by investing in different asset classes, thereby spreading their risks. Portfolio management assists investors in selecting the most suitable investment instruments based on their investment objectives and risk tolerance. Asset management. Asset management is a strategy used by investors to effectively manage their assets. This strategy helps investors increase the value of their assets and minimize risks. Asset management aims to maximize investment returns by efficiently managing assets. Making investment decisions is crucial for investors as they directly impact investment returns. Two main methods used to make investment decisions are fundamental analysis and technical analysis. Fundamental analysis. Fundamental analysis is a method that helps investors evaluate and make investment decisions based on a company's or sector's fundamental data. This analysis considers factors such as a company's financial condition, management decisions, overall sector performance, market conditions, and other macroeconomic factors. These data assist investors in determining a company's true value and predicting changes in stock prices. Technical analysis. Technical analysis is a method that helps investors make investment decisions by analyzing price movements and market trends. This method utilizes charts, indicators, and other technical tools to predict future price movements based on past price movements. Technical analysis helps identify market sensitivities, trends, and bullish or bearish market conditions. These two methods differ in several ways. While fundamental analysis focuses on determining a company's intrinsic value and understanding why stock prices rise or fall, technical analysis focuses on identifying market trends and predicting price movements. Investment psychology is a field that examines the emotional effects on decision-making processes in investment. Emotional investing refers to situations where investors are influenced by their emotions when making investment decisions. Behavioral finance, on the other hand, is a discipline that aims to understand human behavior and its impact on financial decisions. Emotional investing. Emotional investing occurs when investors make subjective decisions due to their emotional responses. This can lead to difficulties in coping with losses and impulsive decision-making. Emotional investing can be driven by the fear of losing or the desire for gain, leading investors to make decisions based on these emotions. Behavioral finance. Behavioral finance is a discipline that seeks to understand human behavior and its impact on financial decisions. It questions many of the models that assume rational analysis of human behavior. Behavioral finance offers solutions to help investors cope with emotional investing. These solutions may include psychological techniques and methods to assist investors in making more rational decisions. Investment tricks pose a risk where investors can encounter illegal and unethical activities such as fraud, insider trading, manipulation, and volume spoofing. These tricks can reduce investors' profits or lead to losses. Insider trading. Insider trading refers to the misuse of confidential information by individuals such as company executives or employees who have access to such information. For example, if a company's executive is aware of an upcoming acquisition offer before it is made public, they could use this information to make stock investments and generate unfair profits. Manipulation. Manipulation refers to a series of activities that disrupt the normal functioning of investment markets and influence investors' decisions. These activities may include spreading fake news, providing investment advice, providing misleading information, and creating high trading volume to influence prices. Volume spoofing. Volume spoofing involves placing fake buy or sell orders to create artificial trading volume. This tactic aims to influence prices and mislead investors. It is more commonly used in low liquidity markets. Succeeding in capital markets requires a combination of factors. Experience, patience, and access to accurate information are among the factors emphasized by successful investors. Experience. Experience is one of the most crucial factors in achieving success in the investment world. Experienced investors can better manage risks by having knowledge about the nature of markets. Additionally, experienced investors can recognize opportunities in the market and achieve higher returns from their investments. Patience. Patience is another important factor in achieving success in the investment world. Markets are constantly fluctuating, and sudden price movements can occur. Patient investors can observe market fluctuations without panicking and make strategic moves at the right time to earn profits. Access to accurate information. Access to accurate information is vital for making informed investment decisions. Investors need to keep track of market trends, sector analyses, and company information. Therefore, staying updated with changes occurring in the markets and companies, and having access to accurate information, is crucial for the success of investments. In conclusion, to succeed in capital markets, it is important to have access to accurate information, practice risk management, avoid emotional decision-making, and have knowledge of investment psychology and strategies. Furthermore, investors should possess accurate and reliable information about investment instruments to avoid manipulation and fraud. Thank you for watching my video. If you liked it, please hit the like button. If there's a specific video you'd like me to make on economic history, don't forget to mention it in the comments section. I wish everyone a pleasant day.
Universal economic history.